All right, today we're going to talk about supply-side economics. Supply-side economics is a theory that economic growth is most effectively driven by lowering barriers for producers like businesses, investors, and entrepreneurs to create goods and services, or getting rid of red tape. The main belief is if you make it easier and more profitable to produce, invest, and work, the economy will expand. Be an expansion, employment will rise, and everyone will benefit. In other words, supply creates its own demand. If you build it, they will come. Key assumption, supply-siders believe people work, save, and invest more with tax rates being lower. Businesses produce more when regulations and costs are reduced. Incentives matter. Changing the reward structure for work and investment changes consumer behavior and producer behavior. Main policy tools: tax cuts. Personal income taxes, lower rates increase the incentive to work and earn more. Corporate taxes, if you lower the corporate tax rate, this encourages businesses, investment, expansion, and hiring, which benefits the U.S. consumer. Capital gains and dividends, reducing taxes on returns from investment encourages saving and investment. The overall goal of supply-side economics, you want to shift incentive to greater productivity and capital formation. Cutting the red tape or deregulation, reduce government rules that restrict business activity. Environmental, labor, or financial regulations. Idea, less red tape, the lower the cost of production, which increases output and innovation. Investment incentives, accelerated depreciation, research and development tax credits, or investment write-offs to encourage companies to spend on new equipment or technology. Monetary stability, a stable money supply and predictable inflation promotes long-term investment. Whenever something's predictable, consumers benefit more or make decisions in the long run better with more information. Some supply-siders advocate a return to the gold standard or strict monetary rates to keep inflation low. Lastly, one of my favorite, a guy named Arthur Laffer, he created the Laffer curve, one of the most famous concepts tied to supply-side economics. This just shows the relationship between tax rates and tax revenue. At a 0% tax rate, government gets no revenue. At a 100% tax rate, also no revenue because no one would work. Somewhere in between is what we call T-star, or the highest tax revenue with some optimal tax rate that maximizes government revenue without discouraging work and investment.